Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, August 26, 2025. It is 11:33 a.m. Eastern Time, so I'm starting the video. So we're about 2 hours into the trading day. Not much going on today, nor do I expect much to happen. We have NVDA reporting tomorrow after the close, of course, and that's obviously the biggest stock in the market right now. Oh gosh, I forget. I read yesterday I think it's like 8% or so of the S&P 500. It's a significant holding, and it's also the largest holding in the Nasdaq 100. You guys can Google those informations of weightings. If you just go to Google QQQ or SPY and go to their website, the issuers, QQQ is Invesco, and you can always get the latest holdings there. They do, I believe, on a daily basis, update it. Either way, it's not just that's the mathematical weighting. Remember that the Nasdaq 100 and the S&P 500 are market cap weighted indexes. On the S&P 500, you have 500 companies, so the top holding isn't going to be the same weighting as it will in the Nasdaq 100. It makes a bigger difference. So, again, so that's the mathematical weighting that says if there's a big move in NVIDIA, it will almost certainly impact the index in that direction. Then there's a psychological weighting. Nobody will argue. I've been saying it for a long time, but again, this isn't any news. NVIDIA is the poster child. It is, I think I read as well, 80 something or percent of AI chips. They have a lock on the market. So again, what they say tomorrow, what they report, I expect nothing less than just like Apple and Amazon and Alphabet always say, with a rare exception, they're always going to beat estimates. They're, when you're a $3 trillion company, you're in the business of managing earnings, and they do that. So again, an earnings miss really doesn't matter. Beat, missed, usually you're going to get the beats, but all that matters is the market's reaction to what they report and more so what they say. I think that's where they give good guidance. Again, once in a while you get a surprise, and that can happen, but it's about what they say going forward, and that's it. Now that can go either way. The way I think it's going to go. As I often say, when a company is scheduled to report, if I look at the chart and I can't make heads or tails of it, near term where it's going, then it's a crapshoot. You might as well flip a coin, and if you plan to hold that position into earnings, you're either going to be happy or sad, or maybe it's a non-event. Who knows? But on the video, I'll get to that in a second. The charts have been big divergences, overbought conditions, extreme sentiment, bullish sentiment, low short interest. All the ingredients are set up that, to me, the risk is to the downside, again, based on the technicals. So if I had to bet, put a gun to my head, I'm going to go short. I will take some cues short because we're on sell signals. That's most important. I'm being very mechanical right now. It's still not that all-in moment yet. There's some levels to go. When's that? Well, as I said, I'd really like to see this T2 level go. I'm starting out here on QQQ because there's really no change. That's why you haven't heard anything from me all day today. I'm going to update a few things for you here, but that's it. So I highlighted on Friday and again yesterday, and here we are again today. So where I thought on Friday, I had two connecting points. I thought it was a valid trend line then. Guess what? We had rejected. We've been stopped. These are 60-minute candles. Almost every single 60-minute candle, majority of them, have been testing that downtrend line off the highs. So now it's, where it might have been an argument before, hey, Randy, there's only a couple, 1, 2, 3, 4, 5 candles there. Now it's becoming more clear to the masses, that trend line I had. So all that means, guys, it makes it a little more technically significant. More eyes are going to see it. Therefore, you may have more longs buy if you break out. Stops probably going to be above it for short sellers. Longs might want to see that breakout. But I'm going to throw something in here. I hate to do it, but that's it. Take it with a grain of salt, anything that happens between now and Thursday, because NVIDIA is reporting after the close tomorrow. So, and then the after-hour session is the wild, wild west. It's less liquidity. There's, of course, the conference call. I always say there's three parts to a company's earnings. The actual release, which immediately man and machine will parse that data, the earnings release report. Machines go a little faster through there looking for keywords, firing off buy or sell programs, depending on what they were programmed to look for in the earnings release, and of course the numbers itself. Then you have the conference call, and I can't tell you how many times I've seen a stock rip or dip one way on the earnings release, only to have a sudden and powerful reversal the other way. Now, sometimes the initial move sticks. Again, guys, it's the second part of it. So that's why, don't read too much into the initial earnings release, even the after hours. And then part three is when what I call the starters step onto the field. You have a lot of the, bench warmers and, retail traders and all that trying to play around in the after hours session, less liquidity, billion dollar hedge funds, pension funds, institutional traders are going to find more liquidity in the regular session. So that's part three. Thursday's trade. How does the stock trade Thursday? And everybody's had time to digest and really parse through all the data, and so sometimes that's where you're it may take a day or so after a company reports to really figure out where it's going. So that's that. The takeaway is, if you're a gambler, you can bet hard going into earnings, whether you're trading an index or any stock. Remember, again, being that NVIDIA is the top dog, top component, largest at 4.3 trillion, Microsoft's number 2 at 3.8, and it goes down from there. Being that's the case, it's going to move the market, so you need to be aware that any positions that you are holding or considering taking between now and Thursday, that have a high correlation in the stock market because they're indexed or for whatever reason they move with it, you might be impacted there. So, all right, there's my full disclaimer or disclosure. Again, just trying to give you guys a heads up. And then that's it. After that, there's always going to be an economic report. Any one of those economic reports or a wild tweet by Trump or anyone else, there's a lot that can happen. So, again, the known risks or variables are the ones I try to highlight, such as NVIDIA, and then a couple of things on the economic calendar this week. So that's it. So where I started the day, no change from yesterday. This is as it was here and here again yesterday in objective short entry with, again, that's just right now the stop that I'm working off of, a daily close above 580. And that would, for example, you could see NVIDIA pop the markets on Thursday, only to see that rally get faded and sold into. So, the downside to using stops on a daily close is on a strong move, you can take it out and then keep building. By the end of the day, be quite a bit above your stop. So again, there's no perfect solution or ways to minimize losses on stops. Again, even the best place stop, I say this often, you might have a hard stop at 580, and then QQQ, let's just say they close right somewhere up here on Wednesday, right? And then Thursday morning gaps up here, let's say 590. Guess what happens? There's two types of stop loss orders you can have. I cover this every earnings season. I cover this a lot because it's important to know these things. A lot of people don't know the nuances between the orders. There's a stop limit order you can place and a stop loss order. So they both SL, so I don't know how to, but okay, so over here you have a stop, let's say limit order here, LT, and then a stop loss, right? The difference is a stop limit at 580 says, stop me out if my stock crosses the 580, hits or crosses the 580 mark, but only sell me at 580. That's what a limit order says. 580 or better. They're allowed to fill you better. If it kissed 580 and immediately reversed, and there were a lot of orders being filled, you could technically get filled at on a short trade we're talking about. Remember, shorts are going the other way. You could be filled at 579 by the time all those orders cleared, but you're going to get filled on around 580. However, if the market's moving fast, even if the stock ran up through, hit 580 but kept going or gapped above it, that stop limit, if it opened at 580.01, guess what? Your stop loss or stop limit doesn't get filled. It says fill me at 580 or better, no worse. And if it opened at 580.01 and then went up the rest of the day and closed the day at 590, you're still short that position. It will not fill. It's an open now triggered. They actually triggered your limit price. So if it crosses back down, hits 580, that they'll take you out. But if QQQ goes to the moon from there, you're still holding those shares. Now a stop loss says fill me when my stop price 580 is triggered. And what it does, it immediately converts that order into a market order. So when 580 is hit or exceeded, so if you gapped up to 590, it's going to fill you right away at the open. Unfortunately, your order, your buy to cover limit order on your short is going to be in line with everyone else's. So those opening order imbalances that you get on a gap will have to clear. So you could open at 590. You could see that's the official open, yet you got filled at 592, let's say. And you're wondering why. I saw it open at 590. Well, guess what? Your order got queued in line, and it wasn't in line beforehand. It was in line that morning once the market opened, and there were thousands or tens of thousands of orders in front of you, and by the time they all got cleared, that's where you got filled. Or it can go the other way. So okay, so you need to know those differences, and that's why I said there's no perfect way to mitigate losses. So we can just work off the best. I like to, in certain cases, use a daily close for the reasons I stated. Markets are volatility's been picking up. You can just see here the move down, the move up, the move down. This is low, slow grind, no low volatility. And so with NVDA reporting up, it's about the only thing I'm going to guarantee you, or not guarantee, but tell you there's a very good likelihood later this week that the market's going to perk up and have some big swings one way or the other. It could all be, again, in one direction, could all be in the down to the upside, or it could be a combination of both. So that's it, guys. I'm just trying to prepare you for what kind of the unexpected, but expect volatility, if that makes sense. And again, the way I think it's going, or I wouldn't have been highlighting these short trades recently. We look at the daily chart. Let's go to NVIDIA itself. NVIDIA, remember, we put in the most recent divergent high right here. This is the first divergent high since this one here, which we shorted. We were short there for multiple reasons, including the trend line break, 6-minute chart, the bearish engulfing candle highlight at the time. And again, it's not that if I didn't highlight, we had divergence building for a while. It was there. We even had a sell signal there. We went back, equaled the high. And so it's the same thing here. I've been highlighting the negative divergence. So as I often say, and I'm going to say it again, negative divergence is not a sell signal, just like positive or bullish divergence isn't a buy signal. It is simply a condition. It is a condition that is typically, and by that I mean more often than not, followed by a trend reversal. Now the problem with divergence, just like getting oversold or overbought can and often does in a bull trend become more overbought or stay overbought. This is my RSI down here. This red line is 70, which is considered overbought in most stocks. And so again, the problem with shorting, you don't short overbought. It's a condition. It's not a sell signal, just like the divergences. But what happens after being overbought for a while, the longer you're overbought, the more deep you get overbought, typically the bigger the odds start going up for correction, especially with you have that negative divergence. Let me fix that line. So there's your divergence line. Let me fix it here. Here, you can squish it down. So you can see the divergence has been building on the PPO for quite a while, and it's been building since right here on the RSI. And so that's it. And again, based on that technical posture, now the trend all day long is bullish. So when you go to your little apps on the phone and then, those things, it's going to tell you the stock is bullish because it's in an uptrend, right? But, a lot of those things don't recognize sell signals and trend line breaks and all that other good stuff. So that's it. And again, it goes either way. And I'm going to tell you now, based on the charts, you can see my divergence lines. We can certainly, this stock could pop post earnings. And if it does, and it breaks to new highs, again, it's not a new high I would chase, because unless it goes up a whole lot, it's only going to increase or expand. I can just move these divergence lines up a little. And so you'll still have divergence, which in my opinion and from my experience, increases the odds that any marginal new high will be a failed breakout. And look, we've been doing that for a while, but the divergence hasn't been taken away. So all we've really been doing in the market and in NVIDIA and most of these stocks that haven't yet peaked or are close to it is continue to build the divergence. And just like back then, I highlighted the that was a divergent high. Then we made a new marginal new still divergent high there. And you can see the divergence was growing bigger and bigger and bigger. And then it finally manifested, as it often, not always, but often does, in the form of a correction. It was a 42% drop, a drop which we were able to milk with near impunity because we covered all shorts as posted and went full long on the morning of August 7th or 8th, whatever the market and NVDA bottom. That was that one too. So that's it, guys. There's my thoughts. And so you know which way I think things are going to go. There's no guarantees with any of this, but we should have some clarity later this week. Let's see. Let's go to the site. I had a chart request, and I'm going to go to this is the most recent post on before this video. What's going on here? Okay, there it is. View comments. There we go. All right. Thanks for answering my question on Wayfair. I covered that yesterday. And I just, to keep these threads efficient, on one set of saying you're welcome. That's the thumbs up I give you. I got that. What do you think of BHC, Bausch Healthcare? And I share these because others I like this. BHC trades very well to the technicals, especially the rallies that follow divergent lows and corrections after divergent highs. Right now, following the impulsive rejection and resistance off the most recent divergent high, BHC is near-term oversold at support with a bounce likely before the next leg down. So here's a stock that I have an opinion on. Sometimes I tell you I don't have an opinion. Now, keep in mind that BHC, I imagine if it's not a component of the S&P, which I think it might be, you can check. Either way, it's most likely going to move with the market. It's a big healthcare company, and healthcare is the third largest sector, I believe, in the S&P 500. And so, as I said, this is the live chart. The other one that you can pull that one up. What I highlighted here, just look how well. This was a divergent high right here, i.e. negative divergence. And what do? You get a nice correction. How did that correction end? With nice positive bullish divergence. You get the rally. So this is a great swing trading stock, at least for my style. Everyone has different styles of technical analysis. I'm not here to tell you mine's right and someone else's is wrong. But as you guys know, this is not the be-all, end-all, but I like to look for these divergent highs and low. ADH is what I call almost divergent low. You made a low, slightly higher low, but you had strong divergence on the indicators. And so that's what I call an ADH. And so that rallied. And then we just recently came full circle. We put in this divergent high, right? Negative divergence. If I would have been asked right here, I would have said the same thing. We're at resistance. I see a lot of resistance, a little head and shoulders pattern right there with two shoulders right there, neckline, and broke down. But you had multiple reactions there, reactions here, reactions there, breakout. So it was a good resistance level. In fact, no, I just added that one today. I didn't know if I had some of these here from before. But so this one was an objective short there, especially at resistance. Not because of the fact it had divergence, because the fact it had divergence at resistance. That's where you make an case to objectively short. It went down. Again, I wasn't looking at the time, so you can't say that's what I did or shared it, but it's been pointed out. And so here I see a gap. I see a reaction there, some reactions there, reactions. So it's coming up on that 7-ish support right there. Doesn't guarantee we'll bounce. You also have the 200-day moving averages right there below, even though it's gone through them a few times, but those tend to act as resistance right there. The 200 exponential kept checking the rallies, and it got rejected. It had a rally back to them there. You can see, again, this blue and red line. So this is where you took them out. Once you were riding above the 200s, you were in a bull trend, took them out there, and then you got rejected on the back test. So they are relevant. And so therefore, if I was, I can make a case objective. Again, the market may foil this, but it's objective long here, down to, but not much below that. I have it at 696. We'll call that 7-ish. And then you have the 200s right there. So it depends on really how far you think this thing's going. And I said in the reply, I don't have really a strong feel on where to bounce. You can take it, get a quick bounce. I like these sometimes what I call reaction trades. Trade bounces off, pullbacks off resistance or bounces off support. And then longer term, if it takes out, clearly loses the 200s, that's going to be bearish. And then this stock is probably it is in a bigger downtrend. I mean, but you can look at this weekly chart right here. I didn't mark it up before, but there's your divergent low again, almost right there, roughly equal lows in price. Big divergence here. And this is a weekly chart. So it again shows you that this stock, more than some others out there, trades extremely well to the technicals. There's your downtrend line, bullish falling wedge. There was your big divergent high right there, negative divergence building for a while from that point, really. And that's it. And you had a nice clean up trend line. I mean, this is a nice, easy stock to trade based on, again, my style, recognize support and resistance. So you have this basing pattern here. And if the market holds up this year and the next, because I think that will certainly help, a breakout above that level would be very powerful. That could be a potential basing pattern, bottoming pattern, big positive divergence. The last time we had positive divergence was right there, and it triggered a multi-year rally, right? So there's my analysis on that one. And again, so that's why I said longer term, if this thing did just bottom and can go on to break out above the range, if you take it, you can just trail up stops periodically and let it run. It's not going to go straight up, but all right, that's that. So again, I'm not crazy about it, but there's trade ideas, and once again, I do this quite often. So if it's a slow day and you want to just catch up, just come into the site, and what I do is I'll try to, when I check on eyeball, okay, there's a new comment there. I haven't checked that one. Let me make sure. Oh yeah, this was yesterday. I told you about the NVDA. Okay, so we already covered NVIDIA. Not much else new to report, guys, really. Did a pretty long video yesterday. The dollar's still holding up relatively well, especially considering the fact the odds shot up for another rate cut. And yet the dollar is still holding off those lows. Normally you would expect otherwise. But remember, the dollar... in a vacuum, there is no dollar in a vacuum. What the dollar is it's the value of the U.S. dollar relative to other currencies. And those currencies are, first and foremost, the euro, which makes up 57.6. So nearly 2/3 or over half of the dollar index is the dollar against the euro. So that's why in a vacuum, the dollar doesn't do anything. It goes up. So what happens is, even though Powell has now started singing his Dove song again, if the ECB is planning to cut rates and telegraphing that and pricing, then they might fall more, and that would support the dollar. And then you also have the yen is the second largest JPY. In the dollar index at a 13.6% weighting. So, and then again, as I often say, everything else. So now you add up those two, and you're at what? Well, what is that? 70 well over 60%. And so again, well over 2/3. Almost 3/4. So everything else doesn't matter. You can add up all the other currencies out there. These are the two you want to watch, and I do. I always watch them in concert with the U.S. dollar. So you can see on the yen here, the dollar-yen pair, that's what this is we have a very, very nice, well-defined uptrend line right here, which was broken. This drop kind of rattled the markets a bit. And we've set up underneath, we've been back testing that primary, the yellow downtrend line, and with this secondary trend line down below, really forming this price channel. So the break of that's going to be bearish. That would be the dollar falling, yen rallying, and recovery back above the trend line would be bullish. Only other things I would just want to loop back to is natural gas. It hasn't broken out yet, but I'm liking it and started scaling into that. USO is the crude oil ETN. You guys know I have my zones on the Treasury bonds as well as zones I created last year on USO. Red, as the colors would imply, red zone market really won't like that. Rarely gets there. And orange zone, again, the higher you go, the bigger impact this has on the economy. Both as inflation, it's what I call the bane of Powell, which is inflation. He wants to be by nature, Powell is a dove, a raging dove, as every Fed chairman has been for years. They kept the pedal to the metal. They kept us at a zero rate policy when they didn't even come close to need it. And they, pardon my French, but they have fucked up the whole financial system. They've created this wealth divide. It's made the rich richer, the wealthier, those that have most of their assets in housing and stock market. That's what the haves do haves. If you're a multimillionaire, you're other than if you have a business, that might be your primary asset. But the most wealthy people out there, their stock market portfolio and their home are their biggest assets. And so what's done, I don't have to tell you, if you had a home, what home prices have done over the last, since COVID, really, since they flooded the system with money, kept rates, near zero. And now we have this situation where nobody wants to sell and give up their 2.5% mortgage and accept a 7% mortgage. So you have that issue, and it's just priced out the millennials. It's priced out anybody that hasn't gotten a home, because home prices remain elevated for that reason. Supply is very low, and we still have stubbornly high mortgage rates right now. So, and that is, again, by the Fed keeping rates artificially too low for too long. There was absolutely no reason. And this goes back, by the way, to the financial crisis. It's been a couple periods of rate hiking. And look at them now. They took rates back to where, normal rates, and they're saying that they're at a restrictive rate. I mean, come on, who are we kidding? Look at the stock market. If rates were restrictive, the stock market wouldn't be at or right off all-time highs. So it's just ridiculous how, it's almost like gaslighting the general public. Rates are not restrictive. And again, your 5-year rate, and you can look at the 30-year rate, but interest rates are where they should be. And if anything, I don't believe they should be cutting now. They will, because the job market's going to roll over, and the Fed's always behind the curve, and you can almost count on that. That's about the one near certainty or predictability you can have with the Fed, is they're behind the curve. They were behind the curve again when inflation started ripping, and everybody knew it. I mean, like I said at the time, Powell probably has his personal shopper go out to the store. He doesn't see his grocery bill. He didn't know what a gallon of milk, a gallon of gas cost, because he probably pulled up in his limo or his driver. The car was already filled up, and that's why these, the Fed's out of touch, and they were. I mean, everybody else knew there was raging inflation after COVID, and Powell was transitory trend until it wasn't, and did the aggressive rate hike. But then what did he do? Bring it back down. Wants to bring rates down. Rates should be where they, in my opinion, at least where they are now. And but again, he'll bring them down. And the most important thing, guys, is we know that he's gonna start cutting. He's pretty much telegraphed that. Where do long bonds go? And that's what I've been watching, continue to watch, and told you they lost control here when they started cutting, and the most aggressive rate cutting campaign in years. Long-term rates went nowhere but up after 3 back-to-back cuts, including the first one, a big 50 basis point cut. And so, we'll see. And I always say there's only one, I've said this many times, in the coming year plus, I think rates will trend up. Near term, I could flip a coin. I don't know. But in the coming years, I believe we'll go higher. We'll break out to those new multi-year highs. And as I've said repeatedly when I cover that, there's no alternative scenario I have for that other than bearish for the stock market. There's no way I can see yields breaking out to multi-decade highs on the long bond and see it as anything but a net negative for the stock market. Unless the Fed does something crazy with dollar printing where they're just debasing the dollar, and therefore a share of stock is going to go up because the value of the dollar is dropping significantly. That's one possibility. But if we do that, you're probably going to see the other Europe, ECB and other countries do that. So whereas this, an abatement or a drop in yields is one of two options. It can be if it's organic and natural. Let's say Powell does thread the needle here, right? Let's just say it starts the rate cutting cycle. It supports the economy, somehow helps the job market, and rates fall organically. That's good. That is one scenario. But if we see yields doing this because the stock market's crashing and it's a flight to safety bid, then obviously that's no bueno, because again, if this is happening because the stock market's going down very impulsively, then of course that's not bullish, right, for the stock market. Okie doke. Oh yeah. All right. So I showed you oil, USO, getting lofty. At let's see. Let's just look on the. I don't have a position in oil, but what you want to see is oil coming down. See, USO just put in this divergent low. You got to be careful. That's a 60-minute chart. You can see right here, positive divergence on the indicators. These are old lines. I haven't updated this chart in a while. But UNG, again, it would help to see oil go down, because typically if when oil goes very high, what happens, they turn on all the wells. You guys probably watch Landman, great show if you haven't. And that shows if the price of oil is high, they're going to start turning on, pumping out wells that were shut down when the prices went down, because now they're profitable. And so therefore, natural gas being a byproduct of oil drilling, you have an excess supply. So when if crude goes down, that tends to be bullish for natural gas, because they start capping wells, and then less production of natural gas and blah 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 blah. So either way, it's a setup, but setup that I think is ripe to pop. This is looking at these charts I showed you before. Again, I didn't have it queued up. We're at a long-term downtrend line that when natural gas peaked and hit to the penny, my long-term price target of 490 earlier this year. What was it last year? That was the trend line I had us ultimately going back to. So we are uptrend line support on natural gas. So while this is shared right now as a near-term swing trade, it's also considered a long-term trade. I will most likely be adding additional targets if we start to go up here, and depending on how the charts look at the time. So I just wanted to state that this is one of the better looking setups right now, and technically it still needs to break out there, but breakout to me, I think it's going to be imminent. So I took a little starter position. I'm definitely have plenty of room to add. I want to see that breakout occur in both UNG and natural gas futures. All right, and then just an update. Again, I like to do this and just reiterate, one of what I believe one of the best value adds on this site is, I'm going to give you my thoughts, give you multiple targets, but I'll also give you my opinion on when I think on a trade we're in, there's going to be a tradable, significant pullback. And I did that the other day when Novo hit our T1. This is a weekly chart, so we hit it this week, T1, and so far we've pulled back just in the last couple days. You've sidestepped a 6% give back, and that's after what was it off the lows, 20+%, 30, I forget. These are, this is where swing traders, a semi-active swing trader, can make money by micromanage a position. So we got a ways to go. I told you the two most objective entries would be pullbacks to either T2 or T1. And at this point, I'm somewhat open to it revisiting those lows. So either way, for the time being, I don't see a re-entry yet. I just wanted to update you on that trade, because it's kind of both a long-term trade idea that I think has nice long-term potential. If we hit that T2 level, remember we bought it here off the lows, that's going to be about a 50+% rally. And then look, if the market's holding up and I like what I see either in this stock and or the stock market, then maybe we come all the way back to this downtrend line. That's very, very much a possibility. I doubt that's going to happen, even though this isn't a U.S.-based company. They do have big operations here. It's a Danish company. But again, the U.S., I know we're an egocentric nation. The world does revolve, Americans think the world revolves around them, but the stock market actually does. You can look at any point in time. When our stock market crashes or goes down, all the other major markets around the world are going down as well. So it's just kind of a fact. In other words, my point is Novo Nordisk going to go and hit that trend line in the next year or two and make 100% plus return if the U.S. stock market hits my longer term target of about a 50% drop? No, probably not. So right now, I'm just taking it day by day, and that's why I do these videos and give you these updates. All right, I think that's about it. Let's. I don't see anything else that stands out. And again, you have NVDA on deck, so we're probably just going to grind around. I wouldn't be surprised to see profit taking in front of NVIDIA earnings. We're not seeing much yet. We're still off that recent high, but again, let's not try to read too much into it. Let's see what they report. see what they say in the guidance, and see, most importantly, how the market reacts to it. Again, that's the end of the day. If you're trading off, earnings, what their actual numbers are, or what somebody tells you out there, an article you read, just about everything that you read or that you hear on TV has already been it's either somebody's opinion, or if it's factual, it's been priced into the stock almost certainly. Those in the know, little birdies, get that information, and it's acted on, and it's reflected in the charts. That's why there's not a trader in the world. There's investors like Warren Buffett that trade on fundamentals, earnings, and things they're working on. But traders use technicals. It's the most, by far, the most accurate, and really the only way to trade if your time horizon is short, measured in days, weeks, or months. Years plus, sure, whatever. If you're good at that, that's your thing. All right, I'm going to wrap it up here and get the video out to you. Like I said, if you want an opinion on anything, throw it down in the comments section below this post or any of the most recent posts, and I'll get back to you as soon as I can. This has been Randy Finney with Right Side of the Chart. Have a great day.